Most people dream of owning their own home, but few have all the money up front to make that dream a reality. That's where mortgages come in. But what exactly is a mortgage? A mortgage is a loan and a legal agreement by which a bank, building society, person, or other financial institution lends money in exchange for taking title of the debtor's property. The condition is that the title is returned upon full repayment of the debt. A mortgage is usually on real property. That's a house, unit, factory, land, and so on. It's usually for a fixed term, say 25 years for homes and shorter for commercial buildings. Most people don't have all the money needed to purchase a home. It is by far the most common way that most people can raise the money to buy a house. A bank will assess a person's ability to repay the loan when considering whether to grant a mortgage. They'll look at how much a person has saved for the deposit, if they have stable employment history, and what their income and expenses are. A bank wants to make sure that if something goes wrong, they can repossess the property, sell it, and get their money back, including interest and fees. They'll look at a loan-to-valuation ratio. This is the amount of the loan divided by what the property is valued at by the bank's valuer, not by you or the real estate agent, or even how much you paid for the property. Most bank valuers will value the property low, so the bank can easily clear the debt if the property is repossessed. Many banks will only lend at loan-to-value ratios lower than 80%. Anything above is classified as risky. The higher the loan-to-value ratio, the higher the risk, and the higher interest charges may be. Most financial institutions will insist on mortgage insurance if the loan-to-valuation ratio is higher than they'd like. This is paid by the borrower and insures the loan so it will be repaid by the insurance company in case of default. In most cases, a significant deposit is required before a financial institution will consider a loan. This is the balance of the loan-to-valuation ratio, 20% or more. The mortgage market is highly competitive, with many banks and other financial institutions seeking to loan money on property. Don't take the first deal offered unless you're convinced it's reasonable and have shopped around to compare interest rates and fees. A discussion with a mortgage broker is often a good way to start your property search. They'll evaluate your ability to repay, give you advice on the amount that financial institutions will lend you, and discuss deposit requirements and other issues. They're typically paid by the financial institution, so you generally won't be asked for payment for their services. Make sure this is discussed up front so there are no surprises later. Be aware that most real property purchases will also involve legal costs, registration costs, and a property transfer tax, often called stamp duty. This can involve many tens of thousands of dollars and must be paid before the title to the property will be registered in your name. There are numerous calculators available online for this, and for loan repayments. With the right preparation and knowledge, your dream of home ownership can become a reality.